CrowdStrike just posted record recurring revenue and record free cash flow, widened its GAAP operating loss, and the stock got hit hard after hours. It's June 3rd, 2026. This is Earnings Unscripted, and we're looking at CrowdStrike, ticker CRWD, fiscal first quarter 2027. Falcon platform, cybersecurity, endpoint, cloud, identity, and now, very loudly, AI security.
Yeah, that contradiction is the quarter. The business engine is still running hot. Revenue was $1.386 billion, up about 6% from Q4. ARR reached $5.51 billion, and net new ARR was a record Q1. That's not weak demand.
And yet, not exactly a confetti moment. The regular session was already down a bit, then the post-earnings tape was, rude?
Rude is polite. The stock had risen modestly over the quarter and finished near the upper end of that period range, but that is separate from earnings day. On earnings day, it closed down 2.4%. Then the latest post-earnings print was down about 14% versus the prior close, near the low end of the extended session range.
Tiny legal umbrella before we get too caffeinated. This is not financial advice, just our personal opinions on the data.
Caffeinated fits. The issue is quality. GAAP diluted EPS fell to 11 cents from 15 cents last quarter. GAAP operating loss widened to $30.6 million, so roughly negative 2% operating margin versus about negative 1% last quarter. But non-GAAP operating margin was 24%, and non-GAAP EPS was $1.10.
So the corporate version of I'm in fantastic shape if you ignore my knee, my back, and the giant physiotherapy receipt.
Exactly. And our packet does not include street consensus, so I'm not going to invent a beat or miss. What we can say is the bar was high, management raised the ARR outlook, and the market still said prove the cash flow and GAAP profit story are durable.
Right, because last time we were talking about CrowdStrike turning an apology into a sales funnel. This time it feels like the story has shifted to AI is creating a security tax on every company.
That's the clean framing. Management's line was basically the more AI an organization adopts, the more cybersecurity it requires. And the human version is not sci-fi. It's developers, marketing, accounting, everybody testing AI tools at work, and security teams discovering shadow AI everywhere.
Very everyday nightmare. Not the machines took over, more Karen in finance pasted a spreadsheet into a tool nobody approved.
And that nightmare sells. AI detection and response ending ARR grew more than 250% sequentially, though they did not give the absolute base. Falcon Flex was above $1.9 billion of ending ARR. Next-Gen SIM was above $600 million. These are product metrics, not GAAP segments, but they're clearly the breadcrumbs management wants investors to follow.
But there's another breadcrumb trail, and it leads to the cash drawer, right?
Yes, they generated record Q1 free cash flow of $468.5 million. Great. But cash still fell about $677 million from Q4. Because they spent $881 million on acquisitions and another $176 million on buybacks. So it's a cash machine, but also, no, let me say that better. It's a cash machine funding a very aggressive shopping cart.
Strong demand, angry stock, AI security gold rush, and a balance sheet doing CrossFit in the corner?
That is unreasonably accurate.
All right, let's get into the details because that free cash flow versus cash decline thing is too interesting to leave sitting there.
Yeah, because the headline is real, but the texture matters. Free cash flow was excellent. The question is, how much of that was the machine itself versus timing in the machine?
Okay, translate that without making everyone open a spreadsheet, please.
Fine. The biggest helper was accounts receivable. They had a cash inflow of about $429 million from receivables. That means customers paid down bills that were already sitting there. Good cash, absolutely. But it's not the same as saying new demand this quarter instantly turned into cash.
Right, so it's like collecting a big stack of invoices from last month's work. Still lovely, but not magic.
Exactly. And then deferred revenue went the other way. On the cash flow statement, deferred revenue was a $36.7 million outflow. And on the balance sheet, total deferred revenue actually ticked down from Q4, even while ARR rose.
That's the little eyebrow raiser for me. ARR up, revenue up, but the prepaid bucket shrinks a bit.
Not a disaster, but you notice it.
You notice it because this company trades on recurring visibility. Deferred revenue is not perfect, especially with contract timing and billing duration, but if it keeps diverging from ARR, you ask whether cash conversion is changing. I don't have the Q4 cash flow detail in the packet, so I'm not going to pretend we can do a clean sequential comparison there.
Appreciate the restraint. Growth podcast host discovers humility, market stunned.
Limited edition. But seriously, management already guided Q2 free cash flow margin to be seasonally low at 24.5%. So Q1 may be strong and still not the run rate investors should lazily annualize.
So record cash flow, yes, but not everyone go home, solved forever.
Correct. And then the second layer is what they did with the cash. They spent heavily on acquisitions, and that's where the story gets more strategic, more interesting, and less immediately measurable.
SGNL and Seraphic, right?
Yes, and this is the key contrast. The acquisition cash was huge, but management said SGNL and Seraphic contributed only $7.8 million of acquired net new ARR. So they were not buying near-term revenue scale. They were buying capability.
Which is either visionary or, a very expensive shopping habit with a keynote attached.
Both can be true for a few quarters. Goodwill jumped by about $900 million, intangibles more than doubled. That tells you the check is being justified by future product architecture, not by current income statement gravity.
And the architecture is basically AI creates new attack surfaces and CrowdStrike wants to own the control room.
That's the pitch. Curds had the clean line. If you want to create AI, you need GPUs. If you want to use AI, you need security. It's very good framing. Annoyingly good.
You hate when the marketing is actually sharp.
I respect it. I also test it. The real question is whether AI security becomes a real budget line, not just a conference room panic. And they did give some useful anecdotes. A healthcare company using Falcon Next-Gen Identity and SGNL to govern what AI agents can and cannot do. That is not abstract. That is someone in IT saying, please stop the robot intern from touching payroll.
That image is going to stay with me. Robot intern with admin privileges. Truly nightmare fuel.
And the SGNL anecdote, where an identity setup that used to take 2 weeks now takes 2 minutes, that matters if true at scale. Identity is boring until it breaks, then it becomes the whole building on fire.
So when they buy SGNL, they're not buying a cute sidecar. They're trying to make Falcon the place where companies decide who or what gets permission to act.
That's how I read it. But, one caution, these product ARR disclosures are not GAAP segments. AIDR up more than 250% sequentially sounds spectacular, but we don't have the absolute base. Next-Gen CM above $600 million is useful. Falcon Flex above $1.9 billion is useful, but investors need definitions, consistency, and eventually profit translation.
Right. Otherwise, you get a basket of shiny metrics and everyone picks their favorite fruit.
Exactly. And while we're on quality, there's one accounting footnote I wouldn't ignore. In the prior 10K, CrowdStrike said it was changing the estimated benefit period for commissions on initial contracts and upsells from 4 years to 5 years, effective FY27. They estimated that would improve FY27 operating income or loss by $85 to $95 million.
So wait, some margin improvement this year is just spreading commission expense over a longer period?
Some, yes. The Q1 release does not separately quantify the Q1 benefit, at least in what we have. It's not scandalous. It may even be reasonable if customers last longer. But it does mean FY27 margin comparisons have a little accounting spring under them.
That's such a Miro phrase, accounting spring. Tiny trampoline under profitability.
I regret nothing, but this is the quarter to me. Demand is not the problem. Execution may be very strong. The issue is that management is asking investors to accept 3 things at once: high growth, heavy strategic acquisition spending, and adjusted profitability that needs careful reading.
So not a weak quarter, more like an expensive conviction quarter.
Yes, expensive conviction is right. And now the market has to decide whether that conviction looks like durable platform expansion or just a bigger bill arriving before the proof does.
Which feels like the perfect place to zoom out, because heading into Q2, the question is less, can CrowdStrike sell? And more, how much patience does this story still deserve?
It deserves patience, but not blind patience. The selloff says investors are not doubting the category, they're doubting how much proof is enough at this valuation.
Yeah, that feels fair. CrowdStrike is saying AI makes security demand more urgent, and honestly, they may be right. But the market is also hearing, trust us while we spend, acquire, and show the clean math later.
Exactly. For Q2, management guided revenue to roughly $1.44 billion and ARR to about $5.79 billion. The real tell is net new ARR, around $285 million implied.
So not, can George Kurtz sell the AI security story? Because he can.
Annoyingly well.
The question is whether it converts into renewals, prepaid cash, and margin that does not need footnotes. Bert Podbury said, quote, "We now expect FY 2027 net new ARR growth to accelerate over FY 2026. That's a big statement.
That's management saying, basically, this is not just a post-incident rebound, it's a new growth curve.
Right. And if Q2 supports that, especially with free cash flow margin expected to be seasonally low at 24.5%, investors may calm down. If ARR looks good, but cash quality still needs explaining, they'll keep pressing.
The bruise is trust, then. Not product trust exactly, more like, how clean is this compounding machine?
Yes, and I do give them credit. Endpoint, identity, SIEM, cloud, AI permissions, it all fits. The danger is ambition outrunning integration.
Brilliant control room, lots of new doors being added while the building is occupied.
My watch list is simple. Q2, net new ARR, deferred revenue, acquisition integration, July 19th residual costs, and whether AIDR gets an actual base number.
Give us the base, not just the fireworks.
Fireworks are nice. Recurring revenue pays the mortgage.
And on that deeply romantic note, impressive company, expensive expectations, and a market that's a little less willing to clap on vibes. Thanks for listening, everyone.
Good night to the vibes.
If you want these earnings chats to just appear when a new one drops, the easiest thing is to follow the show wherever you're listening. And small transparency note, Earnings Unscripted is AI assisted, built from company filings and call transcripts with figures tied back to source documents rather than improvised. If you spot something or want a ticker in the queue, send it to earningsunscripted@datamadness.ca. Take care, and we'll catch you next time.